Tired of feeling lost when it comes to money? Wishing you had more in your bank account? You're not alone. Many of us grapple with financial challenges like living paycheck to paycheck, feeling overwhelmed by debt, or just not knowing where to start with saving. It's a common struggle, but it doesn't have to be yours. Stick with me and I'll break down the fundamentals of managing your money. No fancy jargon, just practical steps to take control. First off, let's tackle budgeting. It may sound boring, but it's actually your best friend when it comes to managing money. Picture budgeting like a personal money map. It helps you navigate your income and expenses, so you never feel lost. So what exactly is budgeting? In the simplest terms, it's tracking your income, the money you earn, and your expenses and the money you spend. By doing this, you can see where your hard-earned cash goes and make informed decisions. Why does this matter? Well, have you ever wondered where all your money disappears to at the end of the month? A budget can answer that. It empowers you to take control, making sure your money is going towards what matters most to you, not just disappearing into a black hole of random purchases. Let's talk about a simple and beginner-friendly method called the 50-30-20 rule. Here's how it works. 50% of your income goes to needs. These are your must-haves like rent, groceries, and utilities. 30% goes to wants, the fun stuff like dining out, hobbies, and entertainment. The last 20% goes straight into savings or paying off debt. This way, you're balancing living in the now and preparing for the future. Now you might be thinking, this sounds great, but how do I actually do it? Well, there are plenty of tools to help you. From budgeting apps that connect to your bank account to simple spreadsheets, you can choose what works best for you. The goal is to have a system that makes tracking easy, so you can focus on making decisions, not crunching numbers. Remember, budgeting isn't about restriction. It's about understanding your money and making it work for you. It's like a financial compass, guiding you to your goals. Whether you want to travel the world, buy a home, or just feel more secure, budgeting can help you get there. So give it a try and watch your financial stress melt away. Next on the list is debt. Yes, it can be scary, but not all debt is created equal. Think of debt as a tool. It can either build your future or trap you in a cycle of repayments. First, let's talk about good debt. Good debt can be seen as an investment that will generate long-term income or value. A mortgage or student loans are examples of this. They usually have lower interest rates and can potentially increase your wealth in the long term. On the other hand, bad debt typically involves borrowing for things that don't provide a financial return. This could be high-interest credit card debt or a loan for a vacation. These debts can spiral out of control if not managed properly. Now that we understand the difference, how do we tackle it? Two popular strategies are snowball and avalanche. The snowball method focuses on repaying the smallest debt first while maintaining minimum payments on others. Once the smallest debt is paid off, you move on to the next smallest, and so on. This method can provide quick wins and keep you motivated. The avalanche method, on the other hand, prioritizes debts with the highest interest rates. By focusing on these debts first, you can save more money in interest over time. Decide on a strategy that best suits your financial situation and mindset. Lastly, never underestimate the power of small wins. It might not seem like much, but an extra $20 towards your credit card debt can save you a significant amount in future interest. It's not just about the money saved, but also about developing a habit of prioritizing debt repayment. Remember, the journey to becoming debt-free is not a sprint, but a marathon. It requires patience, discipline, and consistency. Every extra payment towards debt helps, no matter how small. It's all about taking one step at a time. Now that we've tackled budgeting and debt, let's talk about making your money grow. First things first, before you even think about investing, it's crucial to set up an emergency fund. This is a stash of money, typically enough to cover 3 to 6 months of living expenses that you keep tucked away for unexpected costs. Think of it as a financial safety net. It's there to catch you when life throws you a curveball, like a sudden job loss or an unexpected medical bill. Having an emergency fund in place gives you the freedom and confidence to start investing. Now, on to the exciting part, making your money grow. This is where the magic of compound interest comes into play. Imagine a snowball rolling down a hill. As it rolls, it picks up more snow, growing bigger and bigger. That's how compound interest works. The money you invest earns interest, and then that interest earns interest, and so on. Over time, your money starts to multiply all on its own. It's like planting a seed and watching it grow into a tree. The seed is your initial investment, the tree is your final payout, and the process of growing, that's compound interest. But where do you plant that seed? There are plenty of investment options out there, but for beginners, it's best to start with something low risk. Index funds are a great option. They're essentially a basket of stocks that track a specific index, like the S&P 500. Because they include a wide variety of stocks, they're less risky than investing in individual companies. Plus, they generally have lower fees than managed funds. Another low-risk option is a high-yield savings account. These are just like regular savings accounts, but with a higher interest rate. While the returns won't be as high as with other investments, they're a safe bet and a good place to park your emergency fund. And remember, investing isn't about getting rich quick. It's about growing your wealth over time. So, start small, stay consistent, and let the magic of compound interest do its thing. Remember, the earlier you start investing, the more you can take advantage of the magic of compound interest. Lastly, let's talk about the emotional side of money. It's not just about the numbers. Money can stir up a whirlwind of emotions. Guilt, fear, overwhelm. It's normal. Recognize these feelings, but don't let them control your financial decisions. Remember, it's not about making perfect choices all the time. It's about making better ones consistently. You don't have to become a Wall Street whiz overnight. Just take small steps every day towards understanding and managing your money better. Maybe today you decide to start tracking your expenses. Tomorrow, you could set up a monthly budget. The next day, you might start paying off a small debt. These might seem like tiny steps, but over time, they can have a big impact on your financial health. And here's the fun part. Celebrate your progress. Did you stick to your budget this month? Celebrate. Paid off a debt? Celebrate. Saved your first $100? Definitely celebrate. These wins, no matter how small, are signs that you're taking control of your money. They're proof that you're moving in the right direction. Don't underestimate the power of a positive money mindset. It can make the journey to financial health less stressful and more enjoyable. So keep learning, keep improving, and keep celebrating your wins. Every step towards financial health is a win. Celebrate your progress and keep going. That's a wrap on Personal Finance 101. Let's quickly recap what we've learned today. We've discovered that budgeting is our best friend, helping us understand where our money goes. We've explored the different faces of debt and strategies to tackle it. We've learned the importance of an emergency fund and the magic of compound interest. And lastly, we realized the power of mindset in mastering our money. Like this video for more finance tips? Subscribe for regular breakdowns. Also, check out the links below for more resources.